Hi. The term financial statements mean the two statements prepared at the end of the accounting period of the company, and those are profit and loss account. The profit and loss account, or P&L, indicates the performance of an entity. The second one is balance sheet. The balance sheet shows the position of an entity. We will discuss here the profit and loss account and the balance sheet. If you remember, we have already learned earlier the profit and loss account with trading account, where trading account results were brought down and then indirect costs were deducted from gross profit or gross loss to have net profit or net loss. This was when we have production and then selling. This time, we assume that there is no production involved and trading account is not needed to be prepared. What will be the format if revenues and all expenses are put in one statement to derive net profit or net loss? For example, a company purchases finished goods and sells them as it is in a showroom. All transactions are recorded in their books and posted in journal ledger. Then a trial balance is prepared as shown in earlier video. The following points must be remembered before preparing profit and loss account, and these points are: adjusting the closing inventory. At the end of accounting period, a physical inventory count is being performed to ascertain the value of unsold goods against the purchases during the period. The purchases are expenses, but unsold goods are assets, so a double entry will be passed to record the closing stock. The entry would be: closing entry will be debited in balance sheet as asset, and the closing inventory will be credited in P&L, means purchases less. Adjusting the prepayments. During the accounting period, rents, insurances, etc. are paid a lump sum for a particular period. These sorts of prepayments are recorded on debit as debit in assets at the time of payment. At the time of period closing, all prepayments are adjusted by charging the expenses for the portion of current period, and rest is remain in assets. Now here, the prepaid rent appearing in trial balance is $12,000, which was paid for 12 months. At the end of closing period, 6 months rent is for current period, so 6,000 will be recorded as expense in current year from prepayment. The rent expense will be debited in profit and loss account by $6,000, and prepaid rent will be credited in balance sheet by reducing $6,000. Depreciation of fixed assets. All fixed assets have certain calculated life, so every year a reduction in the value of an asset is charged to expenses as one effect, and the same amount is kept on credit side in balance sheet as a reserve account called allowance for depreciation. The entry is made: depreciation expense will be debited in profit and loss account, and allowance for depreciation will be credited in balance sheet. The next one is bad debts. At the end of the accounting period, the data list is analyzed and reviewed to sort out which debtor has a long pending or unrecoverable balance which needs to be written off by charging that amount in bad debts expenses on debit side, crediting debtor's account. In this situation, the entry would be bad debts expense will be debited in profit and loss account and debtor will be credited in balance sheet. There is one more criteria of recording bad debts. The big companies having huge amount receivables from debtors charge bad debts provision at a certain percentage every year. If any debtor is defaulted, the reserve provision is debited, crediting the debtor. The provision entry would be the bad debts expense will be debited in profit and loss account and provision for bad debts will be credited in balance sheet. Trial balance. As informed earlier, the trial balance is an accounting report which shows the closing balances of all general ledger accounts at a point of time. Let's have a look at the format here. In this trial balance, a sequence has been maintained beginning with current assets, then fixed assets, then capital, then liabilities, then revenues, and at last expenses. Before we prepare profit and loss account, we must take into account a few points, like the accounts appearing in trial balance must be identified, which accounts to be put in profit and loss account and which ones are to be put in balance sheet. Secondly, what are the adjusting entries which need to be incorporated first in trial balance and to draw an adjusted trial balance? The period and adjustments to be incorporated in trial balance, like here in this trial balance, the closing stock valued at 26,000, bad debts written off 17,000, depreciation for the year is 37,800, and the rent expense is 6,000. Let's now incorporate the outside for the information and draw an We'll draw an adjusted trial balance here. Now here is the adjusted trial balance. All the adjustments, the 4 adjustments have been made here. You can see now the adjustment being recorded, such as closing stock has been put on debit side as asset for balance sheet, and second effect, that same will be credited in purchases in profit and loss account. The second one, the bad debts expense has been increased on debit side and debtor being credited to write off his balance. The other one was depreciation expenses has been increased on debit side for P&L, that means profit and loss account, and allowance for depreciation has been credited on credit side for balance sheet. The last one is rent expense has been debited by crediting prepayments. Segregation of account. Now this is the time to segregate the accounts for profit and loss account and balance sheet. Now here we can see the accounts have been segregated. The accounts which will go to profit and loss account are in the profit and loss account column, and for the balance sheet in the column of balance sheet. We must remember that revenues and expenses will go in profit and loss account. Assets, liabilities, and capital will go in balance sheet. Let's now come to prepare profit and loss account. It's clear from the format that we first take revenues. The returns will be reduced to have net revenue, as here net sales. Cost of sale is calculated by opening stock plus purchases minus purchase returns and minus closing inventory. From sales, cost of sales is deducted to obtain gross profit or gross loss. In our case, sale is greater than cost of sale, resulting a gross profit of $395,900. Then after all expenses are deducted from gross profit to obtain net profit, which is $216,900. This profit will be transferred to balance sheet on capital side as capital will be increased with net profit. Now, come to the balance sheet format. As taught earlier, balance sheet is the name of assets, liabilities, and capital. The figures have been accordingly. From adjusted trial balance, it shows total of fixed assets, total of current assets, and net profit already being transferred to capital side. This was all about complete accounting. Hope you would have enjoyed. Thank you for watching.